Another company that's heading toward initial public offering is the Carlyle Group, but some are saying an IPO may take longer than expected. My colleague Cristina Alesci covers the company for us and broke the story that Carlyle was gearing up for an IPO last year. She joins us now with a guest who says Carlyle Group has to overcome some hurdles to get to the finish line. Cristina?
Thank you, Mark. I'm joined by Colin Blaydon, Director for the Center of Private Equity and Entrepreneurship at the Tuck School of Business at Dartmouth. Colin, we've talked a lot about the difficulties of valuing these stocks because of the unpredictable nature of their profits. Tell us a little bit more about why public investors may have a hard time buying their story.
Well, it isn't so much they have a hard time buying the story. They recognize the value. The challenge is in predicting the future cash flows of these companies relative to companies that are other publicly traded securities. So it is hard for an equity analyst who will issue a buy or sell recommendation, will put out a target price for the future, to fully understand these companies and what their cash flows are going to be in the future, and that can weigh on the stock price.
Now, these firms say that they'll reinvest the IPO proceeds to grow and diversify. What does that say about the prospects for future growth in their hallmark buyout business? Are they essentially conceding that this is as good as it's going to get for buyouts?
This is really very interesting because the private equity business has never had trouble raising capital. They have an engine that is very distinctly different from the public markets, where they've raised large amounts of money to invest, and it's called the limited partnership. It's the things that your pension fund and mine, that university endowments invest in, and they raise lots of money through those private vehicles. They've never gone to the public markets to raise money to invest. So they've got a great capital raising engine. The money they're raising this time in the public markets is to give them more currency to further diversify, to perhaps acquire other entities using stock.
Right, but the question, Colin, is, why can't they just raise bigger and bigger buyout funds? I mean, the U.S. pensions may be tapped out, but they can go abroad to some of the sovereign wealth funds and other large institutional investors to grow and diversify without opening themselves up to public scrutiny and having to file a 10K every year.
The fact of the matter is they can still continue to raise that money. Carlyle has recently raised 2 funds above $1 billion. So it isn't that they can't raise the money. What they are looking for is liquidity. Liquidity for the partners who built these firms, want to monetize what they have built, the value of what they've built. So it's a lot to do with that and about using a currency to diversify into other areas adjacent to private equity and leverage buyouts.
Right.
Not that they need the money for leverage buyouts.
Right. But to your point about liquidity and the founders being able to sell their stakes, no one, not KKR nor Apollo, has been able to do that, except for Blackstone maybe back in 2007. None of the other firms have been able to, the founders of those firms have been able to sell their stakes in connection with a listing in New York. What is the probability that Carlyle will be, the founders of Carlyle will be able to do that with this offering?
They are going to have to make sure that their stock price performs well. These stocks have had a challenge. KKR has done better than the others. And KKR came in a different kind of way, not a big public offering, not trying to raise any large blocks of capital. They simply transferred a listing, and their stock price has done better. So if they can take this out, they can do it at a reasonable price and then they can make themselves visible enough so that that price is supported going forward. It's going to be in the future, not in this transaction, that they're going to be able to do secondaries and monetize some of the value they've built.
Now, once Carlyle goes public, 4 of the 6 biggest firms will be publicly traded. The question remains with the 2 others. Bain dealt with its succession issues back in 1999 when one of its founders, Mitt Romney, left the firm. The other outstanding closely held firm is TPG. Are they going to be left behind here, or what does this say about, how they may go about trying to monetize stakes for the founders and diversify themselves?
All of these firms have, in some degree or another, allowed other investors to come in and buy a portion of the management company. And that provides capital to provide some liquidity to the founders and the senior members. It appears that both Bain and TPG have said they, so far at least, prefer being a private company, that they will take care of any liquidity needs that they may have for transition and for the senior partners by bringing in private outside investors and selling a portion of the management company. Remember, what's being sold is a piece of the management company. This is not money that's going into the investment fund itself. This is a piece of ownership which gives them a claim on the fee income, the carried interest, the management fees, the other fees. And a lot of investors find that attractive.
Right. Well, thank you so much, Colin. It's always great talking to you. Mark?
Cristina, thank you so much. Appreciate it.